Hello, my dear fellow valuers. So today we are going to start with our next chapter, which is income approach to valuation. It carries 7 marks as per IBBI Valuation exam syllabus. Till now we have covered valuation of real estate, which carries 10 marks. So put together, after completion of today's session, we will be able to complete 17 marks of syllabus as per IBBI exam syllabus, right? So let us see what we are going to understand in today's session. As per IBBI syllabus, these are the topics which are supposed to be studied by all the IBBI valuation exam aspirants. So, relation between income and value, valuation of property affected by rent control, various acts, derivation of yield rate from market derived data for practical situations, what is remunerative ROI, accumulative ROI, what are the different types of rent, outgoings, income yield, year purchase, determination of market rent, standard rent, then lessee's interest, type of lease provisions, covenants, valuation of lessor's interest, lessee's interest, including sublease of the property, premature termination, real estate as an investment. So these are the type of investment decisions, etc., profit method, etc. So in today's session, we will cover theory part of the subject, and in next session we will take up the examples and case studies which may come up to 20 marks in IBBI exam. So first concept is relation between income and value. Since we are going to discuss about income approach to value, so first of all we have to understand what is the relation between income and value. So in income approach, future income which an asset will generate over its remaining useful life is being capitalized to arrive at capital value of the asset. So whatever income an asset is likely to generate, if we capitalize that income to present value, so that will give us the present value or value of the asset or property. So for my Hindi viewers, just to reiterate the thing in Hindi also, अगर मेरे पास कोई एसेट है और उससे मैं जो भी इनकम फ्यूचर में व्हाटएवर इनकम जो भी इनकम मुझे जनरेट करनी है उसको अगर मैं कैपिटलाइज कर लेता हूं आज की डेट में, तो जो उसकी कैपिटलाइज वैल्यू आएगी दैट इज कॉल्ड value of, that is the relation between the value and income, and that is the capital value of the asset. So if you are confused about what is capital value, I would request you to please go through the previous sessions of valuation of real estate video PPTs which are already given on YouTube. So you will get idea about what is capital value, what is how to calculate capital value of an asset. So next is valuation of property affected by Rent Control Act. Rent Control Act is a full-fledged topic and subject which we are going to cover into chapter number 7, upcoming session on chapter number 7 on laws related to real estate. So keep watching. Valuation of licensed property under Easement Act. Part of it has already been covered by us. What are the different types of easements, rights? This part we have covered into chapter number 1, part 1, session 3 on valuation of real estate. Video has already been uploaded on YouTube and link is provided in the description box below. Further details will be covered in the upcoming session of chapter number 7, laws related to real estate. So next topic is valuation of leasehold properties under TP Act, Transfer of Property Act. So some part has already been discussed in part 1, chapter 1, part 1 and session 3, which is on valuation of real estate, and some part we will also cover in today's session, and next session we will discuss about examples and case studies on this topic. So next concept is yield. What is yield? Part of it we have already covered in our previous session. Just to reiterate it, it is the earning expected on an investment over a particular period of time. It is expressed as percentage of investment amount. So yield is nothing but, if I have invested say 100 rupees into an asset, so what is my expectation out of it, right? So my expectation, it depends on multiple factors that we will discuss in subsequent slides. Derivation of yield rate from market derived data. So for examination purpose, for IBBI exam or valuation purpose, these yield will always been given in the exam, so you need not to assume in any question. However, a state 1 mark question can come from this topic, just to ask you question on various assumption how to arrive at yield rate from market derived data. But in practical situation, as a valuer, we may require to assume these data after gathering data from the market. So how it is to be derived? Let us see. Expected yield on plot and or building is normally directly proportionate to the average yield on long term government securities. So government securities पे जो भी yield मिल रही है market में, उससे एक linkage market में इसमें market accept करती है. There are certain case studies also on this thing, case laws also, and कुछ court के decision भी हैं which justify these assumptions. So that we will discuss in upcoming sessions. So normally it is 1 to 2% more return over average yield rate of long-term government securities as fair return on land investment. So if government securities are giving say yield of 5% and I own a plot, so my expected yield should be in the range of 6 to 7%. And in case of investment in building, building is assumed to be a little bit riskier than land. So that is why people tend to seek more return, more yield in case of buildings. So 2 to 4% extra return is expected over government securities fair return. So if government securities are offering a rate of return of 5%. So if I'm having a building, so my expected yield from the building should be 2 to 4%, maybe 7 to 9%. Right. In case of leasehold property, about two cases are for freehold properties. So in case I have a leasehold property, then 1% extra return is normally expected over and above yield mentioned point number A and B, about 2 points. Now, next concept is remunerative ROI and accumulative ROI. So these are the two terminologies we will often encounter with during the IBBI valuation exam, and a question may also come on any of the two concepts. Normally questions do come. So remunerative ROI, it is the remuneration on capital invested. It is equivalent to R or IC, which we have discussed in previous sessions also. तो मैंने जो पैसा लगाया है उसमें मेरी expected return क्या है? राइट, जो हम पीछे बात की, प्लॉट के लिए 1 to 2%, बिल्डिंग के लिए 2 to 4% अबव गवर्नमेंट सिक्योरिटी आ रही है. इन केस ऑफ लीजर प्रॉपर्टीज इट शुड बी मोर देन 1% अबव फ्री होल्ड प्रॉपर्टी. So accumulative ROI of interest, it is the rate of interest at which annual sinking fund accumulates at the end of certain period to the original capital invested. Accumulated ROI is also called rate of recoupment or rate of redemption of capital. So sinking fund and annual sinking fund we have already discussed in our previous sessions. So if you're not clear about this concept, please go through those sessions on valuation of real estate. I think session 4 and 5 we have discussed this concept, right? So accumulated ROI जो हमने पिछले केस में डिस्कस किया था, we had discussed in the previous slides, previous sessions. IS. So this is the IS, basically the interest at which I am going to invest my annual sinking fund to accumulate my sinking fund at the end of certain period. तो जो मैं पैसा इकट्ठा कर रहा हूँ sinking fund क्रिएट करने के लिए, तो वो पैसा मैं किस अमाउंट में जमा कर रहा हूँ, किस रेट ऑफ इंटरेस्ट जमा कर रहा हूँ, that is my accumulative ROI. It is normally less than remunerative ROI. So this is a trick which I have already given to you from calculation purpose. If we take some real life scenarios, when income from a building is expected to be perpetual or for long periods, say 50 years, investor expect yield equal to remunerative rate of interest. So if my building, my land is there with me for a perpetual period, so I need not to have certain anything for anything for recoupment like thing, because it is going to be perpetual. So my expected ROI and remunerative ROI and accumulative ROI both will be equal. However, in case of buildings with terminal income, like buildings on lease for short period up to 50 years, say, accumulative ROI comes into picture. We will try to understand these two concepts with the help of examples in our next session. So next concept as per IBBI syllabus is type of rent, outgoing, income, yield, year purchase. All these concepts have already been discussed in chapter number 8, part 1, with session number 3. Video is uploaded in YouTube and link is given in description below, description box below. Determination of market and standard rent. Please check out session number 1, part 1, chapter 8 for valuation of real estate, and description link is given in description box. Examples and case studies will be covered in next session. on this topic in subsequent sessions. The lessor and lessee's type of lease provisions and covenant. This is again already covered in chapter number 8, part 1, session 3. So link is already given in the description box. Now let us discuss about valuation of lesser interest. This is very important concept for case studies. So value of lessor's interest in land would comprise of following three parts based on rights held by lessor as per lease term. तो lease term में क्या क्या covenants लिखे हैं, क्या points हैं normally, उसके अंदर से तीन तरह के rights lesser के हो सकते हैं जिसको कि as a valuer हमें valuation करना पड़ सकता है as in practical situation as well as in question numerical also. So capitalized value of lease rent. So first important aspect, important point to be understand is that lease rent payable by lessee as per lease deed for unexpired period of lease. So whatever unexpired period of lease is there, for that period, what is the expected lease rent which the lessor is going to get from the lease lessee, that is to be capitalized. तो मुझे जो भी remaining period में जो lease rent आने वाला है उसको capitalize मैं करूंगा. Examples next study में देखेंगे हम लोग. Present value of right of reversion. Right of reversion we have already discussed in previous sessions, so please go through those PPTs. So I repeat again and again, if you are not following the order in chronicle order, if you're not going through the videos in chronological order, it will not going to help you out. So please start from session 1 if you really want to clear your exam within 100, within 1 month's time. So present value of right of reversion of land on maturity of lease contract. So lessor holds the right of reversion of land. मैंने जो land या building मैंने किराए पे दे रखी है, lease पे दे रखी है, that asset will come back to me, that land will come back to me, and I will be able to sell that land after completion of the lease period. So what is the present value of that land of reversion? Right, market value of rights to lessor to waive any of the restriction imposed under lease contract. So the best example is sharing of unearned profit clause. So if you have gone through the terms condition of the lease deeds, there are certain lease deeds in which certain special covenants are being mentioned. For example, sharing of unearned profit. A lessor gives a land to a lessee on a certain premium, say for 99 years, and stipulate a condition: if the lessee further sells out, further sublet or sublease, or further transfer the land to somebody else, then the extra amount which the lessee will get from the sublessee, part of it will be transferred to the original lessor, head lessor. Right, so we'll try to understand this concept with the help of example in subsequent sessions also. Valuation of lessee's interest. So like lessor has number of interest which can be valued, and lessee also has number of interest. So while doing valuation of leasehold property, first we have to see whose interest is required to be valued by the valuer, in both in practical situation as well as in the numerical. So we have one example on this lesser interest and lessee interest in next session. With the help of that, you will be able to understand how to calculate these two interests. So value of lessee's interest would comprise of following two parts based on right held by lessee as per lease term. तो lease term में जो rights lessee को दे रखे हैं उसको भी capitalize कर सकते हैं. So first of all, capitalized value of profit rental. What is profit rental? It is already discussed in I think chapter number 8, part 1, session 1. But just to reiterate, net rent income receivable from the building for unexpired period of lease. So if I have taken a property on lease on say 100 rupees, and I have further given it on lease to say at say 500 rupees after making some constructions or improvements or renovations like that, after constructing the building on the land maybe. So my net rent is 500 minus 100, that is 400 rupees. So I'm talking about 500 rupees of net rent, right? So for an unexpired period, the capitalization should be done considering dual rate of year purchase. So in case of lessee, always consider, we have to consider dual rate, remunerative ROI and recoup ROI. It is normally given in the examination, and the trick for this thing is that the higher ROI is normally remunerative and lower ROI is normally recoup rate. If plot is not fully developed but it is underutilized, profit rental utility value of such unutilized land till unexpired period of lease has to be considered. So if you remember, we had discussed the concept of habu. So if we have to calculate lessee's interest considering habu principle. If you're not clear about habu principle, please go through the previous slide on habu, I think chapter number 8, part 1, session 3. Next concept is real estate as an investment. Yield from real estate vis-a-vis other forms of investment, sound investment comparison. Normally question doesn't come out of it, right? However, we have covered part of it into chapter number 8, part 1, session 5. You can go through that PPT. Now, important question is investment decision. This is one of the important topics of IBBI syllabus. Discounted cash flow method follows the principle of time value of money. So, time value of money we have discussed in chapter number 8, part 1, session 4, and is based on capital asset price model, CAPM. Normally, numerical doesn't come out of this CAPM model. However, one mark theory question may come, which we will discuss in subsequent slides. They are basically two DCF methods as under net present value and IRR. So these two methods we will discuss in subsequent slides. So what is CAPM? Capital Assets Price Model. CAPM suggests the return on an asset is a function of some risk-free rate of return plus premium for a risk. Right. So as we had discussed in previous slide, rate of interest offered by government securities plus the risk which I presume along with certain risk which I presume while investing in a certain asset, right? So for example, if I invest in a share market, so I presume different type of risk. If I invest in gold, I presume different type of risk. If I invest in land, it may give me different type of risk. If I invest in flat, I may presume different type of risk. So higher the risk, higher the premium. This is the expectation. This is the first principle. So basic formula of cost of equity or risk premium is risk-free return first of all, but whatever rate of return government is giving plus risk premium. So RF plus beta. RM is a market return, return expected by the market, and RF is risk-free return. Let us see in detail what are these. Risk-free return. It is defined as rate of return currently expected from a risk-free investment like government bonds. The return from government of India securities forms the base of risk-free return. So whatever rate of interest the government bonds are offering, normally it is presumed to be equal to risk-free return. Market rate of return, RM. It is the expected rate of return that stock market is expected to generate in India. It is based on BSE index because equity is presumed to be high risk market, high risk asset, high risk transaction. So that is why stock market return, whatever return the stock market is giving, it is presumed to be expected market rate of return. Then beta. Beta is defined as the measure of volatility of a subject investment's return relative to the volatility of returns in marketplace as a whole. I repeat, beta is defined as the measure of the volatility of a subject investment's return relative to the volatility of returns in marketplace as a whole. So जो asset में मैंने invest किया है, whatever asset I have invested in, what is the relative volatility of that asset as compared to overall other market. तो मैंने अगर एक फॉर एग्जांपल एक शेयर में इन्वेस्ट किया है, मान लीजिए एक मैंने HUL के शेयर में इन्वेस्ट कर रखा है, तो और उसकी वोलेटिलिटी पूरी BSE मार्केट से क्या है. So if say Sensex is moving by 10% and say HUL share is moving by 5%, right? So it has low sensitivity. We can say it has a beta of 5%, 0.5, right? So likewise, let us not go deep into it. These are financial terms. So basic idea we should have just for an understanding purpose. Normally no question doesn't come out of it, but still beta is sensitivity of stock return to the market. So it is calculated from using the formula of covariance of stock return to market return divided by variance of market return. So one mark question can come out of it to calculate beta of a asset, and how to calculate this covariance and variance, that we will discuss in our upcoming session on statistics, which we will take up later on. Next concept is one of the next method of DCF is net present value. Normally a question may come or case study may also come on calculation of net present value of the asset, right? Or the examiner may give you NPV of 2-3 projects and may ask what is the combined NPV of the projects. So these type of question may come. Normally 1 or 2 mark question may come out of this topic. So what is NPV, net present value? We have already understood the concept of present value, capitalized value of a cash flow. So we will calculate present value of total inflow from a project. If say we have a project, there must be some inflows फाइनेंशियल इनफ्लो देयर मस्ट बी सम आउटफ्लो, कुछ पैसा आएगा कुछ पैसा जाएगा। तो इनफ्लो जो पैसा हमारे पास आने वाला है, अगर मैंने 100 रुपीज का एक प्रोडक्ट लॉन्च किया या मैंने एक प्रॉपर्टी परचेज करी तो उससे मुझे कुछ इनकम होने वाली है, दैट इज इनफ्लो। और जो मेरे को पैसा जाने वाला है, whatever money I have to pay for purchasing the property and for maintaining the property, that is outflow. So I'll calculate present value of the inflow and I'll also calculate present value of the outflow. तो कितना पैसा आया और कितना पैसा गया, तो जो आया गया वो माइनस करेंगे, that will give me the net present value. So if I earn more, if present value of the inflow to me are more, then project is acceptable, right? But if it is negative, then project is straightforward unacceptable. But if it is zero, then as an investor I may invest in the project or not. So what is the combined NPV of multiple projects? So if I have three properties, property A, B, C, and these three properties are having NPV of say X, Y, and Z, then if I combine these three properties and I want to analyze what is the combined NPV of these three properties, I have to simply add up individual NPVs of these three projects. So example is NPV of A plus B plus C is equal to NPV A plus NPV B, NPV C. So this is a 1 mark question which may come in the exam. IRR. Normally, examiner doesn't ask for calculating the IRR, right? However, we should understand the concept of it. So, theory 1 mark theory question may come from the table which we have given. But for practical situations, I will tell you how to calculate IRR with the help of Gold-Seek formula, which is given in Excel sheet, and we will discuss this formula of Gold-Seek while having presentation on Excel tools and tricks in upcoming sessions. So IRR is the rate of return of a project assuming its NPV is 0. That is assuming PV, present value of inflow, is equal to present value of outflow. So in NPV we had calculated we had some expected ROI in our mind, and based on that we had calculated present value of inflow and present value of outflow. So based on that we have calculated NPV of the project. But however, in this case we will not have any expected, we will not use any expected ROI. Instead we will assume that NPV is 0. So if we assume inflow, present value of inflow is equal to present value of outflow, so what is the given yield of the project? So if that given yield is more than my expected ROI, so if I am expecting say 10% for my return, that is my expectation, and the project in which I am planning to invest, I am thinking to invest, is giving me an IRR of say 12%, then project is okay for me. It is giving a higher ROI, higher expected rate of return. However, if the project is giving me lower rate of return, then I will not accept it. And if IRR is equal to NPV, IRR is equal to expected rate of return, I may or may not go ahead with the project. Next important topic, a case study may come on this topic, is profit method. So this method is being utilized for special properties like hotel, cinema, mall, petrol pump, hill resort. This method is being used to calculate value of commercial property using income approach. And this method again assumes going concern value. So if you remember, we had discussed about concept of going concern value in our chapter 8 part 1 session 1. So 12 marks or 8 marks case study may come on this thing. So let us go ahead and try to understand what are the different steps to calculate the value, property of the value, what are the steps involved into it. So valuation steps are: obtain last 3 to 4 years of financial statement of the business. These accounts should be reliable. For example, you may verify, you can take out those financials from MCA website also. So in practical situations, first of all we have to collect financial data, P&L, balance sheet, companies, and we should be able to read those balance sheets and understand the concepts. And we should take out these data from some reliable sources. And the best source in case of companies, MCA, you can pay 100 rupees and you will get a window for 3 hours. You can take out a company's balance sheet from MCA website. Nobody can challenge you in future that data assumed by you is wrong or correct. So then after taking out the data, you have to calculate gross earning, yearly revenue that business generates. So gross earning you have already discussed in previous sessions. Then calculate gross profit. So my total revenue is equal to gross earning, right? So gross profit is final financial figure after deducting the business purchase cost from gross earning. So that is gross earning minus purchases. So there are two accounts, trading account and P&L account. So these details we will discuss in accounting's upcoming session on accounting, business and accounting and valuation. That carries, I think, 2 or 3 marks in IBBI syllabus, right? So for simple understanding, gross earning, बैलेंस शीट में जो टोटल अर्निंग है, and then my trading account का जो purchases होंगे, that is the expense for trading account expense, that is purchases. So deducting purchases from the gross earning gives us the gross profit. Then there are some working expenses. So day-to-day expenses like electricity, insurance, marketing, telephone calls, which are not directly related to my cost of manufacturing or cost of servicing. Those expenses are being put up into P&L expenses. So थोड़ा सा understanding के लिए मैं बताता हूँ आपको what happens. For example, if I am manufacturing say I'm having a manufacturing unit of steel bar, right? So in that case, my trading expense, my purchases will be steel, scrap, could be electricity, could be my trading expense, right? And then my mobile expenses, my marketing expenses will be my day-to-day expenses, my P&L expenses. So after deducting these working expenses from gross profit will give us the net profit. So first of all, we have to calculate from gross earning to net profit. Net profit is equal to gross profit minus working expense, and gross profit is equal to gross earning minus purchases, right? So then after we will calculate the net profit, then we can calculate property value is equal to net profit divided by capitalization rate or expected yield or expected rate of return, which is IC or R, which we have already discussed in previous sessions also. So case studies we will take up in next session. So that's all for today's session. With this, we have completed our income approach to valuation. It carries 7 marks of theory. So before I tell you what we are going to have in next session, I would again request you to please subscribe to the channel and click on bell icon, and so that you will be immediately notified about next session I will upload. Next session we are going to discuss about various examples and case studies on income approach to valuation, calculation of lesser interest, lessee interest, and some case studies. And as per IBBI syllabus, it carries marks up to 20 marks.